Hi, I'm Steve LaFrance with Blakely Financial, and here are some highlights from the previous month. May marked the continuation of this year's investment trends, with large caps outperforming small caps for a third consecutive month and growth outperforming value for the year. The NASDAQ returned 7.9% in May, bringing its year-to-date gain to 30.9%, while the Dow sits at 0.2% and the S&P at 9.7%. That's an unusually wide range of results, which is also exhibited by the S&P's Equal Weight Index, posting a slightly negative 0.7% total return, underperforming the traditional market cap version by 10.3%. This performance dispersion continues across the S&P sectors. Tech, communications, and consumer discretionary each traded higher in May, with year-to-date returns exceeding 17.5%. In contrast, the 8 remaining sectors each traded lower in May, with negative returns thus far in 2023. The sizable performance gaps indicate that while the S&P is trading higher, the gains in strength are concentrated in a relatively small group of sectors and mega-cap stocks. One of the factors contributing to tech's strong recent returns is excitement around artificial intelligence, or AI, which is being hailed as the next big technological advance. It has the potential to revolutionize the economy by increasing productivity, replacing and/or automating certain jobs, and expanding corporate profit margins. Companies are mentioning AI more on earnings calls, and investors are rushing to find the big AI winners. I'm here to say that years from now, we will all remember this as being like the development of desktop computers, mobile phones, and the internet itself. While AI has the potential to be transformational, we believe it's still in the early innings and will continue to monitor its growth. Congressional debt ceiling negotiations were the primary focus in credit markets last month, and thankfully bipartisan legislation was passed late last week to prevent a default on our debts. Moreover, they voted to raise the ceiling beyond next year's presidential election and into 2025, so we now have another 2 years before this may pop up again. And like I said last month, I'm sure it will. Another significant headline last week was the BLS non-farm payrolls survey, reporting a surprise 339,000 filled jobs, which nearly doubled the expected 190,000. We're now averaging 314,000 new jobs per month in 2023, yet it was interesting that the unemployment rate ticked up from 3.4 to 3.7%. To simultaneously have new jobs and a higher unemployment rate means more people are entering the workforce, which is a positive. Commodity prices have been declining, which could help ease inflation, but also suggests demand is softening and economic activity is slowing. These are just some of the mixed signals the data-dependent Fed will need to consider when they meet again on June 13th. As of today, market analysts are split about 50-50 as to whether the Fed may hold rates steady or pursue another 25 bp increase towards achieving what many are considering the terminal rate of 5.25%. But if they do hold this time, we still expect another small hike to follow. Well, that's it for now. We hope your summer is off to a great start and look forward to hearing about your adventures. Thanks again for your trust and confidence.